Hi, today we're going to talk about Chapter 15, Capital Structure Decisions. Now, this is a slide that you will keep seeing over and over again. Essentially, the idea behind this slide is that the value of any asset or any corporation or any project is a function of two things. The first big thing is that the free cash flows that this project or this company or this uh, asset generates, and the other one is the weighted average cost of capital. Now, the firm's choice of how much capital it raises through debt and how much capital it raises through equity has a very important implication on the weighted average cost of capital. We have already seen that when we calculated the weighted average cost of capital for several companies. Now, the choice of the debt equity mix also impacts the free cash flows, right? So essentially, it is one of the most key decisions that corporations have to make, and that decision is what should be the optimal capital structure of a company. How much debt should they have, and how much equity should they have? So that's essentially the main topic of discussion for chapter 15. So your key takeaway should be how do companies actually choose between how much of their overall capital should be raised via debt and how much should be raised via equity, and how, if the current capital structure is not optimal, how should a company readjust its capital structure to move towards the optimal capital structure. So here again is that same formula that we saw in this. The value of a firm is essentially the sum of the free cash flows divided by the discounted by the weighted average cost of capital. This is again the same formula. And then, we've already done this. The weighted average cost of capital essentially comes from two different sources. It's the weight of debt times the after-tax cost of debt plus the weight of equity times the cost of equity. Uh, the impact of capital structure on value depends on the effect that debt has on both of these things, right? The weighted average cost of capital, right? We've seen that if we keep changing the amount of, uh, you know, uh, the amount of debt that a company uses is going to impact its weighted average cost of capital, right? Because it impacts the weight of debt and the weight of equity. Now, as a company changes the amount of leverage that it has, right? So one of the easy ways in which a company can raise new capital is by borrowing money, right? By issuing new bonds. So as the company increases the amount of debt that it has, typically what you should have noticed by now is that for most corporations, uh, especially after you've taken into account the tax benefits that debt brings in, the after tax cost of debt is usually lower than the cost of equity. So, as a company adds more and more debt in order to reduce the weighted average cost of capital, and a lower average cost of capital is always beneficial for any company because the lower the weighted average cost of capital, the higher is the value to the firm. Also, it becomes much more easier to finance new projects. So most corporations, they strive to have a lower weighted average cost of capital, right? Imagine just running any business, right? Wouldn't it be much easier for you to run the business if your cost of capital was lower? Obviously, right? Because it makes your life easier because your investors' expectations are on the lower side rather than being on the higher side. So coming back to the addition of debt to the capital structure, so if a company keeps adding more debt to the overall capital structure, then essentially what will happen is two things. One, because there is now more debt in the capital mix than the previous existing capital structure, the weighted average cost of capital might go down. Now, again, the emphasis is on might because as you add debt, two things happen. One, of course, the cost of debt is lower, uh, but as you keep adding more debt to the company, the likelihood of the company defaulting or going into bankruptcy increases, right? So as you add more and more debt, your interest payments become much higher and the likelihood of a bankruptcy goes up. So that increases your cost of debt. Now, it also has an impact or an effect on your cost of equity. Now imagine that there are two firms, firm A and firm B. Firm A has very low debt and firm B has a lot of debt, right? So as an investor, if you're investing in equity, uh, firm B is obviously a more risky company, right? Because the moment anything goes wrong, the company is going to face a lot of troubles, issues, because it might go into bankruptcy and the value of your equity might just go to zero, right? So as financial leverage goes up, the cost of equity will also go up. And that will also cause the weighted average cost of capital to go up. So simply by increasing your amount of leverage will not reduce your cost of capital. There is this optimal point, right? Beyond which adding any further debt actually harms the company rather than helping the company's valuation by reducing the weighted average cost of capital. At the same time, there's also implications on the free cash flow of the firm because a company that has higher leverage is going to suffer a lot of issues when it comes to doing business. So company that has taken or borrowed a lot of money, not a lot of suppliers want to lend them more money and so on and so forth, and that can have like real impact on the free cash flows as well, uh, s- primarily through the channel of the working capital, uh, as well as yeah, that's the primarily the main channel, and that could also impact the overall sales and the costs as well, because uh, depending on how much debt you are in, uh, a lot of people might not want to even buy your products because they know if the company is going to go bankrupt in the future, then what's the point of purchasing their products. Similarly, if a company is about to go bankrupt, not a lot of suppliers will want to work with you, right? So uh, the free cash flows also get impacted when your leverage changes. So the capital structure impacts both the numerator as well as the denominator. Now, I have kept bringing this up in the class, but just one reminder again that in 2017, the Tax Cuts and Jobs Act, uh, in addition to reducing the overall tax rate to 21%, uh, uh, they also made this one important change. This important change was essentially that you cannot deduct your entire interest expense uh, as a tax shield. There is a limit on this. The limit is that it should be less than 30% of your EBITDA. And since now we are already in 2023, so anything after 2021, it was made even more restrictive. It cannot be less than 30% of it. The interest expense. The only deduction that you can take is up to a 30% of your earnings before interest and taxes, and whatever is the excess can be carried forward indefinitely. But for most corporations, the carry forward does not help because initially the tax shield was for the entire interest expense. Now the tax shield is a much smaller amount. So companies that were highly leveraged or had a lot of debt, they actually faced a lot of problems because of this legislation, because instead of reducing taxes for companies that were highly levered, the tax rates actually went up. The idea is that all of this will cause firms to reduce the amount of debt that they own. So here is a brief discussion about different types of business risk. So business risk, the risk in any investment or any company comes from two different places. The first is business risk, as is being discussed in this section, and next we'll talk about financial risk, which comes from the leverage that a company takes. So the business risk comes from uncertainty about demand, uncertainty about prices, uncertainty about costs, and so on. So this is essentially your uh, you know business risk can be summarized in one word by thinking of operating leverage. Uh, Operating leverage is essentially it's lower if your fixed costs are lower, and operating leverage is higher if your fixed costs are higher. So operating leverage is the change, the way it's calculated is that it's calculated as the change in earnings before interest and taxes, or your operating profit, caused by a change in the quantity sold. The higher the proportion of fixed cost relative to variable cost, the greater is the operating leverage, right? So as long as your fixed costs are lower, you have low operating leverage, thereby meaning that you have low business risk. So here's an example. So high operating leverage leads to more business risk. Small scale declines can cause a significant amount of uh, decline in the earnings before interest and taxes. So here is your total cost and here is your fixed cost. So between these two companies, this company has uh, a higher operating leverage. Fixed costs are higher for this company, and as you will notice, uh, is that you know if everything goes well, then the EBIT is much greater. But if the company fails to produce this, optimal amount of quantity, then the losses are also severe. So it's a company essentially that has high fluctuations, right? Versus compared to this company where the fixed costs are much lower, you will notice that both the profitability and the losses in operations is going to be much lower. So this is an example of a more risky company uh, when it comes to business risk, and this is an example of a less risky company when it comes to business risk. So the book has an example. Please go through it at your own convenience. It's a fairly straightforward example. I will not uh, talk about this. What I want to talk about and what's sort of the focus of this chapter is that, all right, we can't do a lot about operational or business risk because that's just the nature of the business. But what can be affected or influenced is financial risk, because financial risk stems from how much leverage you have. So financial risk essentially is risk concentrated on the common stockholders when financial leverage is used. So when there is no debt, right, there are a couple of companies which actually do not have any debt. I think Chipotle is one, right? So when a company does not have any debt, then there is no possibility of the company ever going bankrupt, right? So when there is no leverage being used, financial risk is actually almost zero. But as the company adds more and more debt, uh, it's adding more financial risk. Uh, the likelihood of bankruptcy becomes a possibility, right? So, depending on the amount of debt and preferred stock that a company has, determines how much financial risk the company has. So, here's an example of two different companies, firm unlevered, which does not have any debt, and firm levered, uh, L, which has debt. Both of them have the same amount of capital, they have the same amount of operating profits, the tax rate is the same. The only difference is that for firm unlevered, the entire amount of capital comes from equity, which is 20,000. And for levered firm, in addition to having equity, there is also some amount of debt. So the 20,000 total capital comes from 16,000 in equity and 4,000 in debt. And the interest rate that the company has to pay on debt is 8%. Uh, so here let's see what happens to the profitability for both of these companies, right? So if you will notice that the net income that company unlevered generates is 1800, and the net income that the company levered generates is actually 320. Now if you'll notice just the net income number, you'll say that it doesn't make sense to have debt because your net income is lower. But that's not the correct way of looking at this. So if you look at the total amount of money that is returned to investors, so investors get back 1,560 from the net income, and this will go to the equity investors, and the debt investors will get 320, right? So if you add these two up, it comes to 1880 instead of 1800. So the levered firm actually was able to return more money to their investors compared to the unlevered firm. right? So here's a comparison between the key metrics that one should look at whenever you're analyzing any company. So the operating profits were the same for both the companies. Uh, the NOPAT, which is essentially your operating profit times 1 minus the tax rate, is also the same for both of the companies because the tax rates were also same. Both of them had the same amount of capital, which was 20,000. The return on invested capital, which is basically your NOPAT divided by your capital, is the same for both of the companies at 9%. The amount of equity is different between the two companies. The unlevered firm has more equity, the levered firm has less equity. And this was the amount of money that the investors got back, the equity investors got back, 1800 in the case of the unlevered firm and 1560 in the case of the levered firm. Now, if you calculate the return on equity, which is basically the net income divided by the equity invested. So in this case, the return on equity for the unlevered firm is lower at 9% versus the return on equity on the levered firm is higher at 9.8%. Basically, the bottom line is that whenever a firm adds leverage, it's able to generate higher profitability for its equity investors, right? If everything else remains the same. And the reason why that is the case is because uh, this additional 0.8% comes from the fact that the company, if you think about the unlevered firm, is generating sort of a 9% return on its capital, right? Now, when the debt holders are being paid back, they are being paid back only 8%. So the excess comes to the equity holders, right? So as long as the cost of debt is lower than the return on equity, uh, the levered firm is always going to have a higher return on equity whenever leverage is added to a firm. So here are the conclusions. The return on invested capital wasn't affected, right? So financial leverage does not impact the return on investment capital. The return on equity went up, increasing the expected return to the shareholders. Return on equity for the levered firm was greater than the return on equity for the unlevered firm. So here is a look at why did leverage increase the return on equity. So if you think about it, it did that by these two, you know, because of these two reasons. One is that more dollars were paid to back to the investors, 1880 versus 1800. We already talked about this. Uh, there was also low amount of taxes paid, 520 versus 600. So taxes were reduced, and then there was also a lower amount of equity tied up in the levered firm. So the unlevered firm had higher amount of equity, whereas the levered firm had lower amount of equity. Now, the problem starts happening if the return on equity is lower, right? So here in this example, the return on equity is 6% and the cost of debt still remains at 8%. Now, this is a situation where the levered firm is not going to, the return on equity on the levered firm is not going to be as high as the return on equity on the unlevered firm, right? So as you will notice that the return on equity for uh, the unlevered firm, when the operating profit falls to 1200, is 4.5%, but for the levered firm it's actually much lower, right? So this benefit happens only till a point in time where the after tax cost of debt is lower than the return on equity, return on invested capital, sorry. So in this case, when the after tax cost of debt was 6% and the return on invested capital was 9%, the ROE for the levered firm was greater. When it is the same, right? So 6% and 6%, then the return on equity for both the levered firm and the unlevered firm is also the same. But in a situation where the after-tax cost on debt is is higher than the return on invested capital, in that situation, uh, the levered firm is actually going to underperform. The moral of the story is that it's okay to add leverage as long as your return on invested capital is greater than the after-tax cost of debt. If it is lower, the return on invested capital, then the company is actually the equity holders in the company are actually going to be worse off. So there is a point where excess leverage is not good, and that's essentially uh, what this entire chapter is about, to be able to figure out where is that optimal amount of leverage where one should stop. Now, before we go into that, let's talk a little bit about the different capital structure theories that are out there. The most popular one is called the theory, or the Modigliani and Miller theory. It was given by these two economists back in the 1950s. Now, when the Modigliani and Miller model, or the framework, came up, they made a few simplifying assumptions for their model. They assumed that there are no taxes. Uh, the corporate taxes are also low, and the corporate taxes and personal taxes are also super low or non-existent. Uh, so let's look at the Miller and Modigliani theory. The basic takeaway, or the basic conclusion that Miller and Modigliani came out with, was that the capital structure does not impact a firm's valuation. Now, that is true in cases where there are no frictions. So Modigliani and Miller assume that there are no taxes, there is no you know uh, uh, trading costs, and so on. So they made a lot of simplifying assumptions. Under those assumptions, yes, the capital structure should not impact the value of a firm. But in real life, obviously, we have these frictions, right? And because of that, uh, we cannot say with certainty that the capital structure is not going to impact the firm's value. But here is what Modigliani and Miller were trying to say. So they basically said that if you look at two firms, firm U, which is unlevered, and firm L, which is levered, uh, so here the operating profit for both the firms is the same at 3,000. Firm levered, because it has debt, is paying 1,000 in interest expenses. So the net income for the levered firm is 3,000, and the net income for the unlevered firm, for the levered firm is 2,000, and for the unlevered firm is 3,000. Notice that there are no taxes here, right? So whenever we have taxes, this thing becomes different. So the cash flow to the shareholders is 3,000, and the cash flow to the shareholders in this case is 2,000, but the cash flow to the debt holders is 1,000. And if you add up the cash flows, then the total cash flows to both of the two set of shareholders is the same. So as long as there are no taxes, both the firms are identical, because the amount of money that they have returned to their investors is actually the same. So here are the simplifying assumptions that Miller and Modigliani make: that there are no transactions costs, there are no restrictions to short selling, and individuals can borrow at the same rate as corporations. And finally, their final conclusion was that the value of a levered firm is the same as the value of an unlevered firm. And this is a very simplifying model, but it's very useful because uh, after coming out with the simplifying model, they basically came out with models where they took into account what happens when there is actually taxes, right? Uh, so once they took into account corporate taxes, they basically said that the value of a levered firm is equal to the value of an unlevered firm plus the benefit that comes from the taxes from taking debt, right? So the tax shield of debt is essentially calculated based on the tax rate times the amount of debt that was taken. So the value of a levered firm is going to be higher than the value of an unlevered firm. So here, basically, what we find is that a company that is borrowing money is actually going to be valued much more highly than a company that is not valued. Now, again, this is a very simplified model because here we've not taken into account, the problems arising from bankruptcy yet. So this is a very simplistic way of saying that, a company that has taken on leverage is going to get benefits from this tax shield, but they've not considered the issues or the downfall or the problems when it comes to having you know a debt. Uh, Another thing that we need to remember is that with the TCJA, the amount that we can deduct is again restricted, so we have to adjust that. So make sure that you think about that. And then finally, uh, Miller's theory does not incorporate, or so far we've not added personal taxes in the Modigliani and Miller world. If we added that, then essentially the value of a levered firm and its relation to the value of an unlevered firm becomes slightly more convoluted. And this is how the formula looks like, where TC is the corporate tax rate, TD is the personal tax rate, TS is the personal tax rate on stock income. So basically, if you think about a more sophisticated way of thinking, that while there is benefits coming from the tax shield of debt, the debt holders that receive the income, they actually have to pay taxes on the income that is being generated, right? And the same thing happens to shareholders. The dividend income that they are getting, they have to pay taxes on that. So once all of those different sets of taxes were taken into account, the benefit or the benefit from taking on debt is actually not straight just the corporate tax rate times the debt, but it should actually take into account the corporate tax rate, the rate that shareholders have to pay on dividends, as well as the tax rate that uh, bondholders have to pay on the interest income that they are receiving, right? So once all of this is taken into account, this is what uh, the Miller model, Miller Modigliani model looks like once we incorporate corporate and personal income taxes into the picture. And here's an example. Make sure that you go through it at your own convenience. And what are the essentially the conclusions is that the use of debt financing, it remains advantageous, but the benefits are less than only under corporate taxes, right? So one needs to account for the various different tax rates, right? Uh, However, because there are no bankruptcy costs considered here, firms should actually have as much debt as they can, right? Because the moment they keep adding more and more debt, if you think about it from the perspective of a function, this is a positively sloped function, right? So as you keep adding more and more debt, the value of your levered firm keeps increasing, right? So at at the maximum, you can actually go up to all the way to up to 100% debt, right? And that's what most companies should have, because we've not argued about the disadvantages that debt brings, right? So once we consider the disadvantages that debt brings, so this is what happens with debt, right? So in addition to the benefit of the tax shield, there is also this distress cost or the bankruptcy cost that comes in whenever you add debt, right? So the benefit from adding debt looks something like this rather than this straight line. And this is what uh, I was trying to refer to all this while when I was talking about this optimal capital structure, right? There is a maximum amount of debt. Beyond that, if you add more debt, then the value of the firm, instead of going up, actually goes down, right? So we need to figure out what this optimal amount of debt is that a company should have. Now, there are a few other theories that one needs to think about. The first one is the signaling theory. The signaling theory basically says that managers or the corporate insiders know the most about a firm, and based on their actions, the Market sort of takes signals from the decisions that the corporate managers are taking. So if the corporation is selling stock, right? Then based on the fact that if managers know the most about the company, they are only going to you know sell new stock or new secondary shares if they believe the company is currently overvalued, right? Because if the share prices are currently much higher than they should be, then the managers basically they're going to try and issue new capital in the form of equity because they want to take advantage of the higher share prices. Case in point, when we had the craziness with GameStop. GameStop was a company which was very quick to like issue new shares because they wanted to take advantage of the high share prices because they knew that the stocks were overvalued. Similarly, on the other hand, if the management believes that the company is undervalued, then if they raise capital, then the capital is going to be raised in the form of bonds. Now, whether or not this actually happens, that the management believes that the company is overvalued or undervalued, but the moment they raise new capital, either in the form of stock or in the form of debt, these are sort of the signals that the market takes from their decisions. Uh, so most investors will take new stock sales as a negative sign because that means that the company's shares are currently overpriced and the shares are going to go down in price. And based on this, because the market takes these signals depending on the type of capital being raised, the managers actually have to be very mindful of how they are raising new capital. There's another theory which is called the pecking order theory, which basically sort of ranks how a company should raise capital. And the pecking order theory says is that firms should try and raise capital uh, you know in a manner such that the cost is the lowest. So the pecking order theory recommends that the first use of funds or the first source for capital should come from money that is internally generated. So profits that have not been redistributed back to shareholders, that is the first source of your capital, because there are no flotation costs or any signals issue involved. And if there are still more funds needed, then the firm should issue debt because debt has lower flotation costs than equity and also not a lot of negative signals. And finally, if there is no other way and there are more funds needed after having exhausted the other two channels, only then should new equity be issued. Uh, Now, there are also agency costs involved with debt financing. What do we mean by agency costs? Agency costs arise typically whenever there is a, a sort of a agency costs arises whenever there's a situation where an agent and not the principal is in a position to take a decision. So, for example, shareholders actually own the company, but the decisions are taken by the managers. Now, in the case of debt financing and agency costs, essentially what is being said here is that whenever a company uses financial leverage, that financial leverage forces discipline on managers to avoid perks and non-value adding acquisitions. And the reason is because the company has to go back and raise this new amount of capital, and whenever new capital is being issued, uh, you know, the market revisits the company's fundamentals. And the second thing is, uh, as soon as you have to pay a high amount of interest payment, that brings in a discipline because the moment you fail to pay those interest payments, the company is going to go bankrupt, right? So, uh, you know, managers, if they are left to their own devices, they would try to take advantage or try to benefit themselves as much as possible, right? And that could include stuff like golf, expensive memberships to expensive clubs, private jet, and so on and so forth, right? One of the ways in which discipline can be brought is by using debt, because whenever a company has debt, they have to make these regular payments, and if they are in a situation where they have to raise additional capital, then the market, whenever they go to the market to raise new capital, there's an additional amount of scrutiny on the firms. Now, in addition to the overspending agency issue, there's also another agency issue which is called the underinvestment issue. Now, the underinvestment is when the managers or the CEOs do not you know partake in projects and in projects that are that have positive NPVs, right? So whenever a company has a lot of debt, it increases the likelihood of bankruptcy. And even though the managers might come across projects which have positive NPVs, right? They might still not undertake such projects because the projects might be risky. And because they're already having a lot of debt, they want to ensure that the company does not bankrupt. So they might avoid projects, uh, even though they have positive NPVs, which basically then becomes this underinvestment issue, right? Uh, And finally, there is this theory called the market timing theory, which has a lot of support these days. And basically, the premise of the theory is that managers, when they're trying to raise capital, they try to time the market, right? So they issue equity when the market is high, right? So if the stock market is overpriced, overvalued, and the stock prices have been going up for a while, that's a good time to issue new equity, right? And when the markets are at low prices, that's the time to issue debt. Uh, and then they also basically time the short term versus long term debt. So they issue short term debt when the term structure is upward sloping, and they issue long term debt when the term structure is relatively flat. The term structure is basically we go and look at the treasury.gov's website. So the term structure basically means the yield curve for US Treasury. Let me quickly pull this up. So for example, on the 26th of May, this is the term structure. And the short-term rates are much higher than the long-term rates, right? If you notice that the 1 month rate is at around 6.02% and the 30-year rate is at 3.96%. So this is not a normal yield curve. A normal yield curve is this upward sloping graph. So if your y-axis is time, number of years to maturity, and your sorry x-axis is time, and your y-axis is your interest rate, then this is what a normal yield curve looks like, right? Currently, the yield curve that we have is an inverted yield curve. Now, typically, an inverted yield curve is a sign for other markets being bad, right? So the short-term rates are higher than the longer-term rates, right? So usually this is considered to be an indication that the markets are going to, there's a recession looming, right? Uh, so that's the market timing theory, and here are what the implications are of the various theories for managers. The managers should take advantage of the tax benefits by issuing debt. And the tax benefits usually accrue for firms that have higher tax rate. So if you have a higher tax rate, then you get more benefit from issuing debt. If your sales are stable, right? You need stable sales because whenever you add debt, it brings in the distress, the bankruptcy cost. And if your sales are stable, then you don't have to worry as much about bankruptcy costs, right? And finally, uh, they also have low operating leverage. If a firm has lower operating leverage, then basically it means that the business risk is low and the operating profit is also going to be much more stable, just like the stable sales. Uh, and that will basically ensure that you always are able to pay back your interest payments and there is no issue. So whenever you have a corporation which has these three attributes, then such a firm should always try and issue more debt. And finally, managers should avoid issuing a lot of debt if the company has volatile sales, higher operating leverage. They have a lot of potential investment opportunities, meaning that they're a high growth company. If they have already a lot of debt, then they will not take any further risks, and that is probably the underinvestment problem. And if they also have special purpose assets instead of general purpose assets, right? So these are issues, these are the type of companies that should not be borrowing a lot of money. And finally, if managers do have asymmetric information regarding the firm's future prospects, then they should avoid using equity if actual prospects are better than market perceives because of the signaling hypothesis. And always they should consider the impact of the capital structure choices on lenders and rating agencies' attitudes, right? Because whenever you borrow more, it's going to cause your ratings to change as well. Uh, so how does one change the capital structure? So a change in the capital structure can also be brought about without a company actually needing uh, new capital. So imagine a company currently has a 20% debt and an 80% equity, right? And they want to move to a situation where they have 30% debt and 70% equity. They don't need any additional capital for any new projects. One of the ways in which companies can do this is by doing share repurchases, right? So basically, what they can do is they can borrow new money, borrow new, issue new bonds, get additional debt and use the proceeds from the debt to buy back shares and retire those shares. And that's one of the ways in which they can sort of restructure the capital structure of a firm, right? Uh, Now, whenever a company does a repurchase, ideally in an ideal world, it should not have any effect on the share prices. And the reason is because all that you're doing is that you're reducing the number of shares, right? Uh, but in real world, whenever a repurchase is announced, basically it also brings in the signaling hypothesis, right? So if the company's management believes that the company's shares are currently underpriced, then they are going to do a repurchase, right? So whenever a company announces a repurchase, usually what will happen is that the share prices usually tend to go up. Uh, so what I will do is I will give you an example of how a company's optimal capital structure can be, uh, you know, decided. And I will take the Otis example that I was doing in the class before for calculating the weighted average cost of capital, and I will calculate the optimal capital structure for Otis, and hopefully that will give you uh, an idea of how you can do a similar exercise for the companies that you've picked for your project. Thank you.